Hi everyone, welcome to Eric Wealth Advisory. My name is Eric. In a previous video, I talked about wealth accumulation, the common risk instruments and their characteristics. In this video, I'll share the importance of asset allocation, the common pain points, assets versus liability, the risk return curve, the risk of increasing cash holdings during market volatility, the question you need to ask yourself, and the key to asset allocation. The common pain points faced. There's an overemphasis of market timing, which actually increase the risk of missing the best days over the long term. This I will illustrate later in the next slide. Secondly, over concentration of alternative investment, such as cryptocurrency, land banking, real estate, leverage instruments, forex, options, and derivatives. Third, we see investors being overconfident, which actually resulting them in taking oversized trades, which when the trades fail, they actually suffer enormous losses. Fourth, the use of leverage without proper knowledge in derivatives. Five, scamming risk due to lower or fabulous returns. These are the common pain points faced by investors when they do not consider asset allocation. As mentioned, due to the overemphasis on market timing, many investors will actually shift their risk assets into safe havens whenever there is a correction or increased volatility. So for example, by JP Morgan research, a performance of a 10K investment in S&P 500 between September 30, 2000 to September 30, 2020 with a 20-year record, we see that if the investor has stayed invested in the S&P 500 during this period, fully invested, they will have realized a gain of 6.34% total return. Next, if they have tried to time the market by shifting their assets into safe havens and miss the 10 best days, their actual returns could only be 2.27%. This actually have a negative impact on their portfolio if they have missed the best 20 days and subsequently the next 30 days. As a result, one can see that if you are trying too hard to time the market, the results could be damaging not only to your portfolio but as well as your mental state of mind. Before we go into asset allocation, we need to understand what is assets versus liability. Basically, assets generate positive returns over a period of time but can be classified as guaranteed or non-guaranteed, which is also subject to fluctuation and risk. So in short, assets generate positive returns. Liabilities generate negative returns and are non-recoverable over a period of time. In short, liabilities generate negative returns. So the key is you need to understand, are you investing in an asset that is generating positive returns or not over the long run? What is asset allocation? The objective of asset allocation is to make money by taking some risk by investing into the asset class. It's the process of determining how much asset you should hold in the portfolio according to your objective, risk tolerance, and time horizon. Do note, there is no such thing as a perfect asset allocation as it depends on several factors and the risk return curve. In this diagram, in the risk return curve, we can see the potential return on the vertical axis and the risk percentage on the horizontal axis. And there are factors to consider. First of all, it's going to be very different for everyone because everyone will have a different situation. Okay, some have high income, some have low income, some will have lost their job or just recently promoted. So the first consideration will be your own personal financial situation. Secondly, the overall portfolio. As example, 100K portfolio is going to be very different from a 1 million portfolio, and as such they cannot be compared. Thirdly, the objective. Everyone will have a different objective. Some want to accumulate wealth or double their wealth. Some would like to accumulate wealth for their children education. Some would like to accumulate wealth for their retirement. Fourth, the risk tolerance. Some prefer to take a lot of risks so they can get higher potential return, while others do not want to take risks. Fifth, the time horizon. Some people are willing to wait for their investment to compound, while others wants to have a quick profit. Six, your knowledge, opinions and preference. We all have different financial knowledge or background. So it depends on how much you know about stocks, bonds, unit trusts, alternatives. And we also have our own preference and biases. So as example, we can apply this risk return curve on a portfolio level or an asset class level. For example, you can invest in a money market fund here, where you'll be positioned on here. But if you prefer a slightly more risk, you can move up the risk return curve by investing in bonds. Or if you prefer to invest into stocks, you can move up the curve above here. Alternatively, you could also be taking a much higher risk if you like to invest in penny stocks or cryptocurrency. So why asset allocation? It can potentially identify if one is overexposed to asset class, especially with an independent view from a practitioner. With guidance from a practitioner, after assessing your situation, one can enjoy peace of mind and sleep well in all market conditions if one has stick to a financial goal despite market volatility. The benefit of asset allocation, it can offer you potential of higher risk adjusted return. The question to ask yourself, is your expectation reasonable given your current skill, knowledge, limited time and workload to do all this planning, asset allocation yourself? The key to asset allocation, get professional help. No one can time the market consistently over the long run. Are you spending too much time on DIY approach but not getting the results? Have you considered using the services of a financial advisor, or are you still doing alone? Do you desire positive and meaningful changes before it's too late? Need help? If so, please kindly contact me at the QR code below or check out the description below. Thank you for your time and have a good day.